Hello, everybody, and welcome to this week's Nasdaq Dorsey Wright podcast. I'm Jay Greg Manning. Here joining me this week is Will Gibson, and we have a great discussion teed up for everybody today, and it really revolves around a number of indicators that we track at Dorsey Wright that are designed to identify shorter-term overbought or oversold conditions for the marketplace. And specifically, one of those being the implied momentum curve that we track and maintain on our website, as well as a number of weekly distribution or overbought, oversold indicators. And so, let's jump right into it. No need to waste any more time. But when we think about the market today, the market here recently and really over the course of the last month has seen good performance, good returns. The first quarter is in the books, and even here over the course of the past few weeks, as we've started April has continued a positive trend and continued on a positive note. I think it's probably worth noting that historically April is a positive, a very strong month for the market. It also happens to be the month that ends what is historically known as the seasonally strong 6-month period in the marketplace. And so that period being from October through the end of April, with May 1st beginning what is historically known as the seasonally weak period in the market. That will be a discussion for another podcast for sure. But that is just something that we have seen historically in the marketplace, has seen some pretty big performance dispersions between being invested in the strong 6 months in the market, that being again from October through the end of April, versus that the middle months there, the 6 months that begin May 1st, run through the end of October. Over time, a lot of the performance and the bulk of the return in the market has really come from the seasonally strong 6 months in the market. So with that said, nonetheless, April historically is a positive month. April of 2021 has continued that trend in terms of positive months. But what that has done is left a number of these shorter term indicators, the ones that we're using to identify overbought, oversold, into what we would consider to be more overbought conditions, some of which are at pretty high levels, not historical extremes, but certainly high levels. And what we wanted to do is dig into a couple of those and see if there's any cause or reason to be concerned because we're at those levels, or just identify which areas of the market, which pockets of the market are really causing those indicators to move into overbought territory. So with that said, Will, the implied momentum is something that we've talked about quite a bit over the years, and something that we do monitor and view over time. When we look at the implied momentum curve today, where do things stand as it relates to that picture right now?
Yeah, Jay, like you said, I think it really visualizes or puts into perspective what you were talking about. And just as a quick background, if you're not familiar, the implied momentum bell curve, it is placing a universe of stocks. So in this case, we're talking S&P 500 into 6 respective zones, 1 through 6. A stock will fall in one of those zones, depending on its implied volatility calculation that we're deriving from an at-the-money option price. So in short, it's saying what volatility would be warranted for this current price to be in essence justified in the options market. And what I want to reiterate is that the visual picture of this chart is rightwardly skewed right now, suggesting that there's a near-term overbought posture within this universe. There's an average level at the top of the chart, which is simply saying what is the average zone that the stocks are currently sitting in. Again, 6 is the absolute highest that a stock can be in. 1 is going to be the absolute lowest. So 6 would be overbought. 1 would be heavily oversold. It's just under 5 right now. So if you want to visualize that, we're going to throw it up on our YouTube channel. If you're listening to the platform, listening on the platform, you can go under asset allocation and then distribution curves, and you'll see a lot of stocks stacked on that 5 and 6 zone. And keep in mind that this is a normal or designed or usually a normal bell curve or a normal distribution, where we will see more of a normalized effect where most of the observations are somewhere in the middle, so in that 3 to 4 range. And then sometimes in market environments like we have been, they'll get more skewed. And a few dates for reference, if you look back at June of 2020 of last year, we had very similar picture, actually much more aggressive back in June of last year. That average level was north of 5, north of 5.3. And then again in September of last year, we saw that skew rightward as well. So Jay, just a high level, I think that's a great visual to articulate that. And you and I were talking before we got on here, you can actually break it down by sectors as well. And as you were saying, some of those more value oriented, economically sensitive areas of the market have certainly pushed that skew even further. If you're looking at financials, for example, that group is much more skewed to the right than maybe some of your other names. Interestingly enough, technology is going to be one that looks much more normalized right now. They got a pretty heavy pullback earlier in the quarter or end of last quarter, and that's relatively normalized now. But Jay, I think it's a really cool tool and a really cool curve that we try to highlight, and I think it's certainly timely in this market now.
Yeah, absolutely. And the visual aspect of it is, I think really, really important there. And also one other added piece to that is you can see for each stock, not only what zone they're in, but if they have positive implied momentum or if that implied momentum is turned negative based on the color. So if it's positive, it's going to be green. If it's negative, it's going to be red. And so, one thing to watch for, especially within those more overbought sectors like financials, is while the vast majority of those are still green, if you begin to see some of those turn red, and that would be suggestive, certainly, that those curves are going to look to normalize much in the same way that we saw with technology. I suspect if you go back to, say, the market bottom in March of last year and kind of look historically through that, at one point in time, you saw very, very heavily skewed negatively, so skewed to the left in zone one condition back in March of 2000. By the end of March, beginning of April, though, you started to actually see some of those stocks go from red to green and seeing those momentum turn positive for individual stocks. Again, these are looking at very much shorter term indicators and should be viewed in a more shorter term capacity. The fact that it is overbought today certainly doesn't suggest that anything structurally in the market or in any sector specifically is faltering. As a matter of fact, this year, we just saw a ton of turnover with respect to leadership trends in the market, from small caps, from value, from some sectors like financials and industrials, those areas, at the expense in many cases of some of your larger cap and more growth areas of the market. So, that's certainly being picked up on through that momentum curve. Another way that we look to view the market through an overbought, oversold condition is just a data point that we call the weekly distribution or OBOS. And that weekly distribution is calculated for every single stock, and it's based on 10 weeks worth of data that we're basically looking back over the course of the past 10 weeks. And we're looking to see where a stock is relative to essentially its 10-week moving average. And so if you think about a normal distribution bell curve and you turn it on its side, and that normal distribution is showing up on every single stock, where you'll see a midpoint, which is right middle, perfectly normally distributed. The top would be 100% overbought, and the bottom, or BOT, would be 100% oversold. And so if you take a normal distribution bell curve and draw it kind of sideways on each of those stocks, that's what we're looking at here. And so that 100% overbought level would be about 3 standard deviations to the right of mean. The 100% oversold would be about 3 standard deviations to the left of mean. And then again, that midpoint would be perfectly zero. Most of the time, 68% of the time, you're going to fall within 1 standard deviation of mean. And that just goes back to statistics 101. It doesn't matter if we're talking about stocks on their weekly distribution curve, or if we're talking about batting averages across the Major League Baseball, whether we're talking about the male heights around the world. 68% of the time, you're going to see that data set fall within 1 standard deviation of mean. So the further you push towards extremes, either on the top end, meaning pushing higher, or on the bottom end, pushing lower, the higher the probability becomes that particular stock is going to revert back towards mean, whether it's pulling back on its price, whether it's rallying if it had gotten oversold, or whether it just kind of stays still and time goes by and that curve, because it's dynamic, catches up to it. And more often than not, that's typically what happens. If we see an overbought condition, you might see a near-term pullback combined with just some kind of stabilization of price, and that curve shifts up and moves on. And the reason we're bringing this discussion up today is one of the indicators that we look at. We track, again, these weekly distributing readings for every single stock. And then for some indicators, we pull those together in a single universe like the S&P 500, where we can track the average weekly distribution or average overbought, oversold for all of those S&P 500 stocks and put those into our reading. And today that reading has recently crossed up above 40%. And that 40% level is something that doesn't happen all that often. It's not infrequent. I mean, it's happened a number of times over the past years, but it's not like it's happening all the time. Even 50% is even more rare to happen, only happening a handful of times. But that 40% is something that indicator tends to top out around. Now, what's interesting, if you go in and say, okay, that overbought condition, what does that mean historically for the market, or what has the market historically done in other market environments where you got up to 40%? And you look out and you look at the longer term returns. So you go even like 6 months, 9 months, 12 months out, and the returns for the market over that time period are overwhelmingly positive. The 1 month returns are a mixed bag, really, over the course of the past probably 10 or so occurrences that indicator's hit 40%. It's been about 50-50 in terms of a positive or a negative outcome over the 1 month. So over short periods of time, that's where we tend to see some of those periods of consolidation. But the fact that you're up above 40% longer term for the market is historically a bullish sign. It's a good thing. The only way those things get up to those high readings is you have a lot of stocks participating on the upside. And so, like a lot of the other indicators that we've talked about over the really this year, whether it's the positive trend indicators, whether it's, any number of indicators that are at elevated levels that we would consider to be overbought, those only happen, you only get those environments, you only get those conditions in bullish markets and in very, very strong markets. And that's really where we are today. So, near term, some of this stuff is certainly flashing overbought. It historically has suggested you may see some kind of pullback or some kind of consolidation in a short term period, a couple of weeks, 1 month type of time period. But it's not suggestive, at least historically has not been suggestive of any major structural damage that we've seen within the market. So that is certainly something to continue to monitor. And you can do that on any of your individual stocks if you want to see how overbought or oversold any one of your stocks is. If you pull up a chart on our site, there's a number on the top right-hand side that says weekly OBOS, and you'll see a number. For instance, right now for the S&P 500, that number is 89%. So the S&P 500 index itself, again, just remember that the index is cap weighted versus the indicator I mentioned is equal weighted in nature. So that's why you see the difference in that. But the S&P 500 is about 90% overbought. So it's gotten and pushing up close to 3 standard deviations above mean as the market has seen this rally that it's been on. So it would not be surprising to see some kind of normalization with respect to the S&P. And that doesn't mean it's got to fall 10% or whatever. But normalization, again, could mean a combination of prices pulling back, time going on, and letting that curve catch up. So that is certainly something that we'll continue to monitor. On that OBOS side, though, there's a couple other ways, Will, that we can identify that overbought, oversold condition through looking at the weekly OBOS readings.
Yeah, definitely, Jay, and a lot of important points on there that we'll definitely put an exclamation point as we come to maybe a bit of a close here. But you mentioned that SPX OBOS percent reading itself, pushing close to 90%. And just to reiterate, that is the cap weighted overbought, oversold condition of the index. And that pushing to 90%, as you may expect, is not a frequent occurrence. Given the statistics 101, we expect those bell curve distributions to be much tighter toward mean. So when we get higher than this, we will try to make a note of it. And we talked about this a little bit on our report actually on Friday, looking at the S&P 500 cap weighted, so SPX, looking at that OBOS distribution itself. And similar to what Jay was saying, we looked at occurrences when we moved above 80%. And on a longer dated basis, really 6, 9, 1 year out, returns were again very positive for the market and even skewed positively. So the percent of times returns were positive was more than half, pushing almost 80% in most occurrences. And in addition to that, the positive returns were higher than your negative return on an absolute basis. And I'll say that a bit more plainly, because if you look at the short end, so if you're looking at 2-week, 1 month, 3 month, like Jay was saying earlier, with the index, it's a bit more of a mixed bag. On a percent positive basis, you're actually still positive more often than not. Because again, to reiterate, usually when indicators like this get hot, it's part of good market environments, usually more often than not. But on that short term, 2 weeks, 1 month, 3 month, your downside, meaning if your return was negative, it was usually to a greater degree than if your return was positive. So for example, on average, say in the 1 month following, if the market was positive, it was about 1.5% of a return. However, on a 1 month basis, if the return was negative, it was about a -3% return. So we'd say it's skewed leftward for that near term, signaling some caution, if you will, for those that are putting new money to work. Maybe practically that would be look for pullbacks, look for normalization, which is a topic Jay was talking about, where we just hang steady more or much. Maybe we go back and forth for some column changes, establish some higher support, consolidate for lack of better words. And then those are some more times to put money to work. Because again, Jay, for the long term, indicators like this hitting these breadth levels have been very positive, and coupling that with our other longer term indicators that we're really not going to touch on today too much, but we've touched on in the report and the podcast before, are largely positive, signaling very much of a risk on posture. But other than that, I think that's a key point today. If you're looking for some shorter term things to gauge market breadth, or as well as gauge market overbought, oversold conditions, you got your implied momentum curve, you have your WD SPX, and then as well as those individual overbought, oversold readings. I think that'd be very helpful.
Yeah, I think that's right, right, Will, and that's great. It's always good to gain some perspective as some of these indicators do hit higher levels, and in some cases, high levels that we haven't seen in a while across a number of our indicators. But with that said, to your point, general trends remain positive for the market. Equities as an asset class continues to be strong. And while we're at a near-term overbought condition in the market, does not spell any trouble, or at least historically has not spelled any trouble longer term for the market. So with that said, Will, appreciate you joining this week. Enjoyed the discussion. I hope everybody did as well. Thank you all for joining us, and we look forward to talking to you next week.